All right then, good afternoon then folks, as we head into another week of trading on Monday the 23rd of October. We'll have a flick across the calendar, we'll jump across some charts and see what is going on as we begin the week with a pretty quiet economic docket. You can see nothing high impact over the course of today. Into tomorrow, we do have some consumer confidence figures out of Germany and some manufacturing PMIs. We'll have a look at both of them with a keen eye. Consumer confidence, you have to imagine, not expecting to be good as consensus suggests. Does it come in below that? Obviously, that remains to be seen tomorrow. Manufacturing PMIs, obviously not good, have not been good for a year in Germany as well. So expecting a couple of forward-looking indicators. Obviously, consumer confidence, forward-looking indicator, manufacturing PMIs, forward-looking indicators, both expected to be negative as we head into tomorrow. Consensus 40, above the previous 39.6, but still below 50, still a dreadful number in terms of the manufacturing figures, and you can't imagine they are too positive, or either of them are too positive, judging the current circumstances globally. Some labour market figures from the UK. Retail sales, dreadful on Friday of last week from the UK. The unemployment rate, and you'd expect that to tick higher at some point. Does that tick higher in tomorrow morning's session? Well, obviously have to see. But then some business climate figures out of Germany finish off the high impact data from the Eurozone this week until we get into the ECB. Now, the ECB not expected to hike interest rates again as a foregone conclusion. They will not hike interest rates again on Thursday, and you'd have to imagine that they are done. Christine Lagarde at their last meeting did suggest that monetary policy was at a sufficiently restrictive level. You'd have to imagine that she does not change that terminology with the ongoing situation globally, with growth in the Eurozone not exactly great. ECB have no reason to continue to hike interest rates, and you'd have to imagine the next move in interest rates with the ECB is probably lower. Slightly different scenario in the US, though. GDP expected for this, or for Q3 should I say, at 4.2%, so extremely strong growth figures out of Q3 in the US, which then leads us into earnings results. Some of the big tech names out over the course of this week, and with 4.2% growth in the economy, that they are then expected to be positive earnings. And the more positive earnings we get, the more it drives treasury yields higher. Now, the move in treasury yields higher is likely to keep the Fed from hiking interest rates at their meeting last week. This is what we need to keep an eye on. You can see this 10-year yield has broken 5% for the first time since 2007. The 2-year yield has moved slightly lower, but the 10-year yield continues to push higher, which reinforces the narrative of higher for longer interest rates, and positive earnings are likely to drive that higher. Now, positive earnings are positive for stocks. We can see the S&P 500 over the back end of last week, and to start this week extremely negative, right? Strong downtrend over the last 7 days in US stocks. That is compounded by the fact that the 10-year yield continues to trend higher, and that is enough of an influence on the economy for the Fed to not have to hike interest rates. But positive earnings will probably reinforce the fact that they will need to keep interest rates higher for longer, may even potentially follow through with that hike that they did keep on the table, and that is likely to be further negative for stocks. Couple that with the geopolitical headwinds, with the tensions in the Middle East looking like they are set to escalate, with the US sending a warning towards Iran. You know, if Hezbollah get involved and the situation escalates further than what it already has done, and it becomes a more widespread conflict within the Middle East, that will be further negative for business conditions. So there's a lot of negativity in markets at the moment. You know, rising yields negative for stocks. You know, positive economic data, positive earnings will cause yields to be continue to be supported, should I say, and that is likely to be further negative for stocks. Gold, you would expect to see sell off the back of rising yields, but with geopolitical tensions in the air, gold sought after as a bit of a safe haven, and you know, trend is clearly higher on gold. And you'd have to imagine, or certainly I would imagine, that these all-time highs, these triple lot of all-time highs, I mean, obviously the first one is the all-time high set back in mid 2020, but this level up here of kind of between the 2050 2070 level up here, you'd have to imagine or I would personally imagine that will probably be tested at some point. You are rejecting off this bit of a resistance level that we got up here at 1985, but I would expect that to break, especially if geopolitical tensions continue to rise. The path for gold has been pretty one way over the last couple of weeks. That probably looks set to continue back up towards another test of those all-time highs, even in the midst of rising US yields, especially if US yields pull back. Gold should continue higher. So I do think the path of least resistance on gold is higher, and it would make sense for gold to continue to push higher. Oil continues to trend higher. You can see clear higher lows and higher highs at the moment. Now it's holding on to the support level down at 88.20 that we have got in here, rejected off that in the overnight session, and probably looks set to continue its move higher. The trend is your friend. You got to back it with tensions in the Middle East potentially worsening. That is a situation where oil continues to push higher. A bit of US dollar strength, the dollar relatively supported across the board back end of last week, but ultimately pretty choppy across the board on the US dollar. So US dollar maybe not the best thing to trade at the moment. Equities downside, you can see across the board, your S&P, your Dow Jones, your Nasdaq, your Russell all trending lower, your DAX, your Euro stocks and your FTSE all trending lower, and the VIX continues to push higher. This is not a good situation for stocks, whatever way you try and read into it. 10-year yield rising, positive GDP figures, which will likely in turn cause positive earnings figures. All that likely to keep hopes for the Fed to keep interest rates higher for longer. All that is negative for stocks, plus any escalation on the geopolitical tensions out in the Middle East again is negative for stocks. It's just a recipe for stocks lower, and that is how you would have to imagine that continues for the rest of the week unless something changes, which ultimately it doesn't look like it will change, certainly over the course of this week. So you'd have to imagine it's set to be a negative week for stocks. Certainly have opened up like that. Follow on from last week. GDP figures on Thursday, durable goods orders on Thursday, both expected to be positive. Both of them likely to keep interest rates for higher for longer in the US. Comes around to PCE on Friday, which again is the Fed's preferred metric of inflation. Consensus for 0.3 month over month for the core figure, expect to be higher than previous. Again, that's not a situation where they finish up interest rate hikes, or at least talk about finishing up interest rate hikes. It's a recipe for things that you have to imagine stocks continue lower. See, no, that's not sure, but we are in the business of making calculated guesses. Judging by the way things are lining up at the moment, that is how we would expect markets to play out over the course of this week. So stocks lower, gold and oil higher, dollar likely to be supported as we head into trade for the rest of this week.